and welcome back to the Property Pilots. Today we're talking about buy-to-let mortgages, and this video is going to break down in great detail everything involved around a buy-to-let mortgage. Okay, so welcome back. Today we're talking about buy-to-let mortgages, and it's quite a comprehensive video. We'll be talking about lots of different aspects and variables of buy-to-let mortgages. So hopefully by the end of the video today, you'll fully understand buy-to-let mortgages and all the options that are available. I was actually due to fly today, but I'm not sure if you can even hear it in the microphone, but it's gusting 40 knots, which is absolutely incredible. So if any of you are landing at Leeds Bradford International today, or attempting to land at Leeds Bradford International today, good luck. You're probably going to be diverted somewhere else, maybe Manchester. So we'll see how that goes. Okay, so what is a buy-to-let mortgage? Well, let's just break this down into two parts, and we'll cover this very, very quickly so we can move on for those that already know what it is. So a buy-to-let property is essentially where you're buying a property and renting it out. Very nice and very simple. A buy-to-let mortgage is where we are mortgaging or financing this property that we intend to rent or let out. Really, really simple. So essentially it's getting a mortgage on this property, on this investment property that we're renting out. Really simple. So let's move on to, what do we need to qualify for a buy-to-let mortgage? Really, really important. And don't be too put off and don't be too scared here, because there are a lot of ways around getting around certain aspects if you don't necessarily pass a certain criteria. There are lots of lenders in the market, and there are some specialist lenders that really focus on those that maybe would struggle to normally obtain and qualify for a buy-to-let mortgage. So let's go through this in a bit more detail. First of all, it's slightly easier if you're a homeowner. If you own a home yourself, it's slightly easier to get a buy-to-let mortgage. But don't worry about this. If you don't own your own home, it's absolutely fine. Nowadays, there are lots of lenders willing to lend on the basis that you don't own your own home. So don't worry about that. It is slightly easier if you do, but it's not all, it's not a deal breaker, and you'll still be able to find a good lender. Next, your history, your track record, your reputation, your experience, that's really important too. So, if you're a first timer coming in here looking to obtain your first buy-to-let mortgage. Okay, don't get me wrong, there are lots of lenders in the market for that, but it does help if you do have experience, if you're a track record, or if you're termed what's called a portfolio landlord. So I've forgotten exactly what number it is, but I think maybe over 5 properties lenders, will call you a portfolio landlord, and will treat you slightly differently to a landlord who has less than 5 properties, or one that's completely new to the game. So, normally if you've got 1 or 2 properties, it's a slightly easier, but then again, don't be put off. There are lots of lenders nowadays that will lend to first timers. Okay, so your credit score, really important. So you've got to make sure you've got a decent credit score, and if you don't know what yours is, you can sign up to, there's lots of different suppliers. I've used Experian before in the past, and I do think they have a free trial as well. So, consider, signing up to that, have a look at your credit score and see if you can further enhance and build your credit score. I actually checked my credit score out a few days ago because I applied for some bridging finance on a property, and I was happy to see it was 999, which I think is the highest mark you can get. And it's very, very simple to increase your credit score. If you don't have a credit card, I'd suggest getting a credit card and making sure you put all your purchases on the credit card, but making sure you pay that off in full every single month, and don't go into that period where you'll start paying interest and accruing other costs. So really important, and that will help build your credit score. So generally speaking, before we move on to the structure on this property acquisition, the mortgage here, it's more about the property than the individual. So obviously when you're buying, your live-in domestic owner-occupier house with that mortgage, your residential mortgage, it's more about you. It's not really about the property. Well, it is in some respects, but it's more about you as an individual. Whereas when you come to the buy-to-let world, it's more about the property than the individual, than you or I. So, what we'll talk about now is the structure. How are we buying this property? Is it through a personal name, or is it through a limited company? Really important question to ask. And if you don't know the answers to this, 2 things. First of all, watch my video on should you buy property in your personal name, or should you buy in a limited company? I'll link it in the description. And also speak to your accountant, because he or she should be able to advise. And if you don't have a specialist property accountant, head to my website, ms7.uk, and I can put you in touch with my accountant. So let's move on to the type of mortgage. And generally speaking, there are 3 different types of buy-to-let mortgages we can opt for and choose from. Now, the first is the most popular, that's the fixed rate mortgage. It's a fixed term mortgage. So let's say we're fixing this mortgage for 2 or 5 years. In the UK, they're the two most popular options. So we're fixing this mortgage for 2 or 5 years at a fixed rate of interest. And obviously the benefit to that is we know for those 2 or those 5 years what that monthly mortgage cost is going to be, and we can accurately forecast and plan. The next option that you have is what's called tracker rates, and tracker rates will go up and down depending on the Bank of England base rate. So again, something you may want to opt for. Now, the last option is variable rates. And this is typically what happens when your fixed term mortgage comes to an end. And if you haven't already remortgaged onto another fixed term or something else, then that variable rate will kick in. And the lender can pretty much charge you whatever they want. And it works in a similar fashion to tracker rates. They'll normally add a markup onto whatever base they mark up from. Okay, the next thing we need to think about is, are we going interest only? Or are we going to repay the capital also? So a really important question that you have to ask yourself. Now, most buy-to-let property investors, they will opt for an interest-only mortgage. And the reason they do this is because that maximizes their cash flow month on month, because that monthly mortgage cost is less than what the repayment mortgage would be. Because with the repayment mortgage, you're also paying back that loan itself and not just serving the interest in the interest only option. So it's a video I'm going to make actually. I'm going to make another video about this topic in a bit more detail, but essentially it's not like where you're buying your own living house for yourself, where you're also repaying that capital, or most likely repaying that capital. I'd say probably 95% plus of residential mortgages are capital repayment mortgages, but in the buy-to-let world it is slightly different, and investors normally opt for interest-only mortgages. I really like interest-only mortgages, especially if you're undergoing the income investing strategy in property, because it maximises your cash flow and it maximises the money that you're making every single month. And there are different ways in how we can actually pay off that capital that we have no intention to pay on that monthly basis. So obviously if we're selling the property in 5 years, then we can pay back that capital that we've actually borrowed in the first instance, or maybe we are remortgaging onto a slightly different mortgage, and of course that's one way of paying back the capital. A nice little point to note here is that inflation erodes the debt. So if you are taking out an interest-only mortgage and maybe you're slightly worried or slightly thinking about, oh gosh, how am I going to pay back this capital? Well, think about inflation. As inflation increases year on year, that's going to erode the existing debt, that capital, that lump sum that you're borrowed in the first instance, and over time you can really use that to your power, and over time that whatever you've borrowed will be worth far less in the future, as that pound will no longer buy the same equivalent pound in that future date. Okay, so let's get on to loan to values now. What are loan to values? So essentially a loan to value is how much are you asking for compared to the value of that property. Nice easy example. So let's say a property is worth £100,000 and we want a £75,000 mortgage. Well, 75 over 100, that's 75%. So we're asking for a 75% loan to value mortgage. And 75% is the most typical buy-to-let mortgage. Again, you can opt for more, you can opt for less. If you opt for more, you typically will pay a higher rate. And in my opinion, it's not worth doing because that rate isn't actually feasible and it's not really worth doing. But alternatively, there are investors that will take on less risk and they will reduce their loan to value to say 50 or 60%. Of course, you're going to have to increase your deposit to make up for that. But again, it's a way of minimizing your risk and maybe you can get an even better interest rate. So let's come on to the deposits very naturally. So if we're getting a mortgage at 75% loan to value, then we need to fund that deposit, which is 25%. So that deposit can vary depending on the loan to value. Now it's really important to think about where this deposit is coming from, because some lenders are really strict about where this deposit is coming from, where others are a bit more flexible. So is this deposit coming from your savings, from your employment? Is it coming from maybe family? Is it coming from inheritance? Is it coming from some other form of income? Where's it coming from? Are you borrowing it from someone else actually? There are lots of lenders that will not allow it, or standard buy-to-let mortgage lenders don't like it if you're borrowing money from someone else who isn't family. So you've really got to think about that. Speak to your mortgage broker, because if you are utilising funds from someone else that isn't family to fund that deposit, then you'll need to approach specialist lenders that will be okay to lend to you on those terms. So, if your deposit is from, savings, if it's from inheritance, from family, things of that nature, most buy-to-let lenders will be absolutely fine with that. Okay, so interest rates are a really important variable to consider, if not one of the most important things in this video. And your interest rate will differ depending on the structure of your mortgage. So if you're buying the property in your personal name, typically speaking, the interest rates are slightly less than buying in a limited company. But don't be fooled by that. Generally speaking, for most property investors, again, speak to your accountant, but for most property investors, you're better off buying in a limited company. Even though you pay slightly more on an interest rate, you will actually save more on the tax side. And again, watch my video that I've referenced earlier on. Now, another thing that impacts upon interest rates is, as I mentioned before, the loan to value. So the higher the loan to value, typically speaking, the higher the interest rate is. The lower the loan to value, the lower the interest rate, because the risk is less, and as a result, the interest rate is less. So that's one thing you may want to think about. And I find 75% is a very nice sweet spot. Okay, let's come on to stress tests. Now, this is something that a lot of my mentees, when they first start with me, struggle to understand, but I'm going to break out a nice, simple example. So the lender, and you should be doing this anyway, but the lender will want to stress test your property purchase or potential property purchase to make sure that if things do go wrong, then they're somewhat covered, and you'll still have a high chance of being to repay this mortgage. And what they'll look at is two things. So first of all, they'll stress test this particular deal on not the current rate that you're paying, but a higher future rate that, if rates were to increase, can you still actually make money on this deal? So let's say, for example, as I record this in January 2023, there are stress tests that, each lender is slightly different, but I just done one today at 7%. So even though you can get a limited company buy-to-let mortgage somewhere between 5 and 5.5% today, they will stress test it as a higher 7%. So again, you've got to work out the math. Does that still work at 7%? But what they'll also do is they'll add something extra to it. So they'll if you work at that figure, and we'll do the maths now. So let's say we want to borrow £100,000 and we're being stress tested at 7%. That monthly mortgage cost is £583. But what they'll do now is they'll times that by a certain percentage to make sure that, again, they are covered. And what I've been using most recently, because I'm a higher rate taxpayer, is 145%. Sometimes if you're a lower rate taxpayer, they'll use a lower percentage, which is 125%. But let's just times this by 145%, because most property investors are higher rate taxpayers, and this will come out at £845. So essentially, as long as your rent or potential rent from this property is above £845, you will pass this stress test. So I hope that makes sense. Lastly, let's talk about the fees and the costs. I know you don't want to hear anything about this, but we have to address the costs. Now, there are lots of different fees and costs we need to think about, both from the lending side, but also from your broker. So let's first of all start with the mortgage lenders. So a lot of them will have an admin or a product or an arrangement fee. So you have to pay a fee to take out this mortgage and this product. And this can range anywhere from, 1% to 5% of the actual mortgage. And what I'm seeing a lot in the past 3-4 months is lenders actually offering a much higher product fee and reducing the interest rate on their mortgage, so it seems a bit more competitive. But really, once you've seen this higher product fee, it's not that great, and rates don't sound as good as what they actually are in real terms once you account for that product fee. Again, speak to your broker, he or she will be able to advise. So lenders may charge you a product fee, and they may also charge you other fees as well, like survey fees, valuation fees, or legal fees, things of that nature. Now, exit fees and early repayment charges are really important. Each lender, again, will be slightly different on these. You could be paying 1 to 5% of the mortgage to exit early, depending on when you actually exit and how early that exit is. So again, speak to your broker here. It's really important depending on what strategy you're looking to pursue with this particular property acquisition. And lastly, you have your broker fee. So you should be paying your broker a fee to carry out the work that he or she is doing for you, and to push through your application and to prioritize that application. So again, that's something to think about. And this could be anywhere from free, some brokers don't charge a fee, to maybe £500 per application, depending on the nature of the property. Okay, so that more or less concludes buy-to-let mortgages, and we've explained pretty much the A to Z of buy-to-let mortgages. I may have missed out one or two things, but here are really the salient points and the really important things you need to consider. So what shall I do now? Maybe you found a property deal and you're looking to get a buy-to-let mortgage, well, speak to a mortgage broker. If you don't already have a mortgage broker, head to my website, www.ms7.uk, click on work with my team, and I'll introduce you to the mortgage brokers that I use, I work with, I know, I like, I trust, and I'll make sure you're in very good hands. So very shortly, I've got a video coming out which is everything you need to know about qualifying and about obtaining and what you need to get a buy-to-let mortgage. So if you're not already subscribed to the channel, consider subscribing, and this video will follow shortly after this video you're watching is published.